I'm Katie, and we're excited to have you join us to learn about IRAs and tax returns. I hope you are snuggled up in a warm and cozy spot at home listening in on this cold night. In this webinar, you will discover how to make smarter financial moves and maximize your savings. This session is perfect for members looking to enhance their understanding of IRAs and how they tie into tax returns. In this webinar, you'll learn about Roth versus traditional IRAs, which one or both fit your financial goals best, contribution limits, plan effectively, and stay within the limits, 401k and pension rollovers, explore options to safeguard your retirement, tax season prep, what forms you'll receive if you have any, and have any IRAs. So those are the things we'll cover. We have really super knowledgeable IH speakers tonight that we want to share. We have Paige Vanderheiden. She's the Deposit Products Administrator, Senior Credit Union Relations. Paige has been with the credit union over 4 years. She spent the first couple of years serving the members in our retail branches. Most recently, she has been working in the back office, specializing in IRAs and deposit products. Paige received her Certified IRA Specialist 1 designation in 2023. She is currently working towards the Certified IRA Specialist 2 designation later this year. Welcome, Paige. We also have Jim O'Leary, financial coach at our 52nd Avenue Moline location, also known as Spout. Jim has been with the credit union for over 26 years and in the financial industry for 34 years. He has a bachelor's degree in finance from University of Northern Iowa and an associate's degrees in marketing management and banking and finance from Kirkwood. He has been using IRAs to increase his tax returns since he was in college. Welcome, Jim. Before we jump in, I wanted to remind you that everyone is muted for the entirety of the session tonight. If questions arise during the session, please place them in the chat and we will address them at the end of the webinar. We also wanted to be sure that you know that this session is being recorded for future viewing purposes. So without further ado, I'll hand it over to Paige and Jim.
All right, before we get started, I am not a tax professional. For advice about how an IRA would affect your specific tax situation, please seek competent tax advice. You can also reference IRS publication 590A for more information. We're going to start by outlining some basics of IRAs. IRA stands for Individual Retirement Arrangement. They're established to hold assets or funds for an individual's retirement, often in addition to other retirement tools, such as a 401k, 403b, 457b, or a pension. It's always good to max out any employer matching benefits of those plans before contributing to an IRA, which can come in several different forms, including savings, money market, or certificate of deposit, or any combination thereof. IRAs can also be invested in various market-based securities, such as stocks, bonds, mutual funds, etc.
It's a retirement account that you have more personal control over, and that's one of the big benefits of this type of account.
IRAs can potentially provide significant income for retirement and offer tax benefits along the way. It's never too early or too late to start contributing to an IRA, but remember that time is your friend when saving money. While there are several different IRA categories, traditional, Roth, SEP, simple, and inherited, we'll be talking about traditional and Roth. These are both common ways to save retirement and each have unique benefits.
I look at the traditional IRAs as my cost of living when I retire. I'll take out so much each year, pay my taxes on it, and use that to cover my living expense money. The Roth IRA I look as my party money when I retire. I take funds out, do what I wish with it, and I don't have to worry about any tax consequences.
So why would you get an IRA? It's a tool for a better retirement, a tax advantage savings. You have control over your contributions, penalty-free withdrawals for certain expenses, and the potential for tax-free withdrawals in retirement.
I look at the IRA as a tool for a better retirement. I don't want to rely only on Social Security. An IRA, pensions, 401k type plans are all part of a well-rounded retirement plan.
As we talk through some of the whys of IRAs, we're going to be helping Sam. Sam would like to retire when he turns 65. He contributes to his 401k to take advantage of his employer match, but would like to open an IRA to supplement his retirement fund. Let's talk the traditional IRA type. A traditional IRA is defined as a tax-advantaged personal savings plan where contributions may be tax deductible. Contributions made to traditional IRAs may be fully or partially deductible depending on filing status and income, and the amounts in a traditional IRA are not taxed until you take a distribution. Anyone with earned income can contribute, but your ability to deduct those contributions is based on your income. We will touch on what is and is not earned income soon. All that to say, anyone can open a traditional IRA savings account and make contributions throughout the year. We'll touch on amounts allowed later on in the presentation. And then when it is time to file taxes, the contributions can be deducted or reduce your income, so you're not paying income taxes on this money right now. There are no income limits for contributing to a traditional IRA, but deductibility may vary. This type of account may be advantageous for those who want to reduce their income while saving for their retirement. There are immediate tax benefits, and this IRA type is good for people who expect to have a lower income in retirement. Remember to speak with a qualified tax professional about what that would mean for you.
I've looked at traditional IRA as a tool to lower my federal and state taxes since college. 1 year in college, I was only able to put $15 away, but it did get me 7 more back on my tax return, so I called that a win. Last year, my daughter made her first traditional IRA contribution. She put $52 in and got 10 more back on her tax return. There are rules for an extra form. So Schedule 1, Part 2, Line 20 for the 2024 tax year is a form you'll have to add. This is for the people who claim themselves and not for kids that are still being claimed on their parents' taxes. We got to follow the rule Uncle Sam's makes. We play his game and we play by his rules, and we'll be okay.
If Sam was to start contributing to a traditional IRA now at age 30, we can take a look at what that would mean for him at his goal retirement age of 65. Making some generalized assumptions regarding steady tax rate, final tax rate at the time of retirement, and low level of contribution increases over time, if Sam starts contributing $1,000 per year and increasing that contribution amount by $100 every year, his traditional IRA taxable ending balance would be $215,000 roughly, including growth from dividends earned. And his after-tax balance would be $150,856.
So let's look at Sam, assuming he's making $50,000 a year taxable. He's currently single. Looking at the IRS tax table for 2024, on $50,000 taxable, his tax would be $6,059. If he made a $3,500 IRA, traditional IRA contribution, that would lower his tax from $6,059 to $5,356, saving him $703. If you invest or deposit $7,000, it lowers tax to $4,931, saving him a total of $1,128.
The other type of IRA we're going to talk about today is a Roth IRA. Roth IRAs were created by the Taxpayer Relief Act of 1997 and went into effect in 1998. So they're much newer to the IRA world than traditional, which were created in 1974. A Roth IRA is defined as a tax-advantaged personal savings plan where contributions are not deductible, but qualified distributions, including interest earned and increased market value, may be tax-free. This differs from the traditional IRA in that you are paying income taxes on the contributions right now at your current tax rate, rather than waiting until you take distributions down the road when your tax rate may be higher. Anyone can contribute to a Roth IRA if they meet the following criteria. They have earned income and have a modified adjusted gross income below the set limits. I'm not going to go too deep into modified adjusted gross income, but the 2025 limits are listed for married filing jointly, married filing separately, single, head of household, and all other filing statuses. Just like with a traditional IRA, you can contribute to a Roth all throughout the year. The money put into a Roth cannot be deducted or reduce your income. This type of account is considered advantageous for people who believe they will have more earned income later in life than they do while they're contributing to their IRA.
I had my kids start this type of IRA once they started working. Time is on their side with this. I told my kids to put in $5 or $10 per pay period. They wouldn't notice it, but it'll give them a really good nest egg when they are ready to retire.
Now knowing what we do about the difference between a Roth and a traditional, we can see how Sam's retirement account would differ if he were to choose one or the other. Again, making some generalized assumptions regarding steady tax rate, final tax rate at the time of retirement, and low level of contribution increases over time. If Sam starts contributing $1,000 per year and increasing that contribution amount by $100 every year in his Roth, the ending balance would be $161,632, including growth from dividends earned. The difference between the traditional after-tax balance and the Roth balance would be almost $11,000. In both the traditional and Roth slides, we mentioned earned income as being a requirement to contribute to an IRA. The IRS has outlined what they consider to be earned and unearned income. Since the ability to contribute to an IRA is tied to earned income, it is good to know the difference between the two. Earned income is going to be more commonly your wages, salaries, tips, other taxable employee pay, net earnings from self-employment, independent contractor or statutory employee pay, and less commonly, non-taxable combat pay, minister's housing, strike benefits, and disability benefits. If you're retired on disability, benefits you receive under your employer's disability retirement plan are considered earned income until you reach minimum retirement age. Minimum retirement age is generally the earliest age at which you could have received a pension or annuity if you were not disabled. Beginning on the day after you reach the minimum retirement age, payments you receive are taxable as a pension and are not considered earned income. What is not considered earned income and cannot be counted towards the ability to contribute to an IRA is investment type income such as taxable interest, ordinary dividends, or capital gain distributions, or unemployment compensation, taxable Social Security benefits, pensions, annuities, cancellation of debt, and distributions of unearned income from a trust. For both traditional and Roth IRAs, contributions are broken down into current tax year and prior tax year. From January 1st to December 31st, you can contribute to the current tax year, but from January 1st to April 15th, tax day, you can choose to contribute to the prior tax year instead of or as well.
I like to put money aside each week for both types of IRAs. At the end of each year, when I do my taxes, I will look and see how much more I can put into a traditional for additional tax savings. That's why my IRA contributions are always an unusual dollar amount. If you're not sure what you want to do if you want to go with a traditional or Roth, I told members to put funds in a normal savings account, and then when they file their taxes, they can make that decision because you can file for the previous tax year until April 15th.
The amount of money that can be deposited into IRAs is subject to contribution limits that are set by the IRS. Their definition is the lesser of the annual contribution limit in 2024 and 2025, that is $7,000 or $8,000 if you are 50 plus years old, or 100% of the eligible compensation or earned income. While traditional and Roth IRAs are different, they are both still IRAs, and when it comes to contribution limits, they are considered one bucket. This means that you can choose to contribute to one or the other or both, but in total, you can only contribute up to the current year's limit. It would be best to discuss with an advisor about the option of having both accounts for diversification of tax benefits. A simpler explanation would be that if you are under 50 years old and have earned income that will total more than $7,000 in a year, you can contribute $7,000. If you are over 50 years old and have earned income that will total more than $8,000, you can contribute $8,000. Or if you are any age and have earned income that will total less than $7,000 in a year, you can contribute up to the amount you earned. These amounts apply to any traditional or Roth IRAs you contribute to as a whole. As we know, Sam is 30 years old and makes $50,000 per year. He contributes $3,500 to his traditional IRA and $3,500 to his Roth IRA. He is within the IRS limits. Hannah is 16 years old and makes $6,200 per year. She contributes $520, about $10 a week, to her Roth IRA. She's within the IRS limits, but could only contribute up to $6,200 total. Spousal IRA contributions allow a working spouse to contribute to an IRA for a non-working or low-income spouse, enabling couples to boost their retirement savings. In the event that Sam and Nicole were to get married and Nicole did not work or did not have what the IRS considers earned income, he could make spousal contributions on their behalf. Sam could contribute up to $7,000 to an IRA held in his name and an additional $7,000 to an IRA held in his partner's name, as long as they are filing a joint tax return.
So again, back to Sam making $50,000 a year taxable, filing, if he puts $3,500 away, as before, his taxable income would be his tax return would be, he would increase his tax return by $1,128. If he puts $7,000 for him and his wife into the retirement account for a total of $14,000, he'd increase his tax return to $1,968.
You can remove funds from your IRA at any time, but there are guidelines for those withdrawals. Withdrawals made after age 59 and a half are penalty-free from both traditional and Roth IRAs. Prior to age 59 and a half, withdrawals taken from an IRA are subject to a 10% early withdrawal penalty from the IRS.
Remember, moving money from one IRA to another is not a withdrawal, it's a transfer. So here at the credit union, if you have an IRA savings account and you move $250 to an IRA CD of the same type to get a better rate, it's just a transfer. You can keep adding to the IRA savings account and build that up and then add to that CD when it comes due again, or combine them at that time.
If you take a withdrawal from your IRA before you turn 59 and a half years old, there are a few exceptions to the tax penalty. These include birth or adoption expenses up to $5,000 per child, death of the participant or IRA owner, disability, total or permanent of the participant or IRA owner, or qualified first-time home buyer expenses up to $10,000. This is not an extensive list, and further exceptions can be found in IRS Code Section 72T2. It is important to note that the IRS does require withdrawals to be taken from a traditional IRA in the form of required minimum distributions, or RMDs. RMDs begin currently the year the IRA owner reaches 73 years old. The amount is set by the IRS as being the fair market value, or the balance of the account as of 12/31 the previous year, divided by a distribution period from the IRS's Uniform Lifetime Table, which means that the amount will change year by year. These distributions are considered income and are taxable. Roth IRAs do not have a distribution requirement since the funds in a Roth have already been taxed.
When this time comes, we can help you set that up to be an automatic transfer to make your life easier. There are options for when and how the money comes to you. Traditional IRA withdrawals are taxable, but depending on your income tax or your income, it may not matter. Social Security income is not currently counted as taxable income, so a person on Social Security only and a traditional IRA could withdraw. A single person can draw up to $14,600 as a single filer, $21,900 as head of household, and $29,200 for filing jointly. This amount of withdrawal might be offset by the standard deduction. My parents withdrew the $29,200 and they didn't have to pay any taxes on it.
Depending on the actions taken on an IRA throughout the year, contributions and/or withdrawals, you will receive corresponding tax forms. When you take a distribution or withdrawal from an IRA, this will generate a 1099-R, titled by the IRS as distributions from pensions, annuities, retirement or profit-sharing plans, IRAs, insurance contracts, etc. What kind of IRA you have and your age will determine how the distribution is coded on the 1099-R. These tax forms are due to IRA owners by January 31st. For contributions, a 5498 is generated, and this is titled by the IRS IRA Contribution Information. 5498s are informational only and are not due to IRA owners until May 31st due to the prior year contributions being permitted through tax day. You do still need to report your contributions on your tax return. The form itself is not required by the IRS. Roth IRA contributions are not reported as they are not tax deductible. I know that was a lot of information in a short time, so let's do a quick summary and go over a couple of quick tips. Traditional IRA contributions may lower your current taxable income, while Roth IRA contributions do not. Withdrawals from a traditional IRA are taxed as ordinary income in retirement, whereas qualified Roth IRA withdrawals are tax-free. Roth IRAs have income limits that may restrict high earners from contributing, while traditional IRAs generally allow anyone with earned income to contribute. Traditional IRAs require a minimum distribution starting at age 73, but Roth IRAs do not have this requirement during the owner's lifetime.
I personally do not think it's a traditional versus Roth, but a blend of the two that will help most people. More Roth in your early years and more of a mix in your later ones.
I've included the contribution limits on this slide as well. Don't forget to take full advantage of any employer matching benefits your retirement plan may have before contributing to an IRA.
Always look at that 401k plan, depending if what work offers you, depending on their matching programs, and that's bonus money for you. If you leave that job, you can roll your 401k plan into your IRA of the same type.
New in 2024, the Secure 2.0 Act allows for tax-free rollovers from 529 plans. A 529 plan is a tax-advantaged education savings plan to Roth IRAs, subject to specific conditions and limitations.
This is new, so I have not helped my kids start this rollover, but it's coming for two of them. My fear with the 529 plan is, what if my kids don't go to college or enter a trade or the military? What becomes of that 529? Well, now we can roll into a Roth IRA for them. It counts as a Roth contribution for the current tax year. So it may take a number of years to get the full limit, which is currently at 35,000, moved. But it makes me feel better for their retirement plan and that 529 plan as well.
We're going to bring Katie back to take questions now.
All right. Awesome. Thank you guys so much for sharing your knowledge with us. There's a lot of great information. It was a lot covered in a short amount of time. So we do want to open it up for questions. You're welcome to place any questions that you may have right in the chat. I did have a couple just myself that I thought I would throw out while we're waiting for any questions to come. Jim, you had mentioned when you were talking about an IRA savings and an IRA CD or certificate. Mm-hmm. Can you kind of share the difference of those and what they mean?
They're the same thing because they're in the same bucket. It's just an IRA savings you can contribute to on a weekly, bi-weekly, monthly basis. The IRA CD is the credit union requires a minimum of $250 for that CD, but it's locked in there for a certain period of time at generally a better interest rate.
Okay.
So you can use one to feed the other.
Yeah, that makes sense. Great. Thank you for sharing that. I see some people typing here. As I wait for those questions to come in, I'll ask another. If I have an RMD, so required minimum distribution, that is pulled out, how does IH determine which of my IRAs to pull it from?
So we start with any non-time deposit. That's going to be your IRA savings or your IRA money market, and your RMD comes out of that share first. If that is depleted or you only have IRA CDs with us, we will start taking the RMD out of your lowest earning CD share. And those withdrawals, since they are required by the IRS, are penalty free from your certificate.
Okay, nice, wonderful. That's very helpful. How about another here? How early can I start an IRA for my kids?
Once they start working and have taxable income. So great. Earned income is what they need, and then we can start that.
Perfect. I have one here. If a 50-year-old, as a 50-year-old, have both 401k and Roth 401k, what % of income should we be putting into a traditional IRA? That would require some math, right?
Okay,
I think that question would best be answered by either a tax professional or a financial advisor, since it's so specific to each individual.
guess the key is making sure they don't go over the maximum contribution limit, which would be 8,000 if they're 50.
Great. Thank you for that guidance. Appreciate it. Another one here for the contribution limits. If someone has a Roth and a traditional, the total limit for both of them is 7,000 or 7,000 for each.
The total for both of them is 7,000. So if you were to contribute 7,000 to a traditional, you couldn't contribute anything to a Roth and vice versa, or you can do a mixture of both.
Assuming they're under 50.
Assuming they're under 50.
Great. Good deal. And can you give us an example of a 401k employer match? You referenced that during your talking points. So
A 401k plan, let's say you are putting 5% in, and that the company will match half of what you put in. So if the maximum they'll match the 5%, they're going to give you 2% or 2.5%. That's free money as long as they're long enough to have what's called a vested interest in that. So it's free money because they're matching what you contribute. When you leave the company, you'll get everything that you put in.
sure. Great. Free money is good. Thank you for that example and for answering those questions, you guys. Some great questions tonight. We do appreciate everybody's participation as well. And if you have any other questions about IRAs or are interested in opening one, we have QR codes up on the screen to capture the path to book an appointment. You can book an appointment with Jim here, who's been speaking tonight at our South Park Out Branch, Moline 52nd Avenue. If you are on your phone attending and you aren't able to capture the QR code, you can use the short link below that, plug that into your web browser, and it will take you straight to the spot to book the appointment. If this location isn't convenient for you, we also have Kelsey. You can book an appointment with her, Kelsey Ratz. Same thing, you can use the short link or the QR code. And then we did want to step through, once you use that QR code or short link, in order to book that appointment, there are some steps there. It will pull up the location that you chose. You would want to select the service that you're going with. So open an IRA, select the date and time that works best for you. Put in any information that would be helpful notes-wise for us to know when we're meeting with you, your email, phone number, those good things. And then click that book your appointment button, that blue button there. And just a reminder that meetings and appointments with our financial coaches are free. So pretty awesome opportunity. Be sure to watch for a follow-up email from us over the next couple of days with a recording of this session and a survey. We'd love to hear your honest feedback about how the webinar went for you tonight. Also, please watch for other free webinar opportunities that will be available monthly for sign up. Our next virtual webinar will be on Thursday, February 20th. It'll be here before we know it. And that's also going to be at 6 p.m. And the topic's going to be how to build credit. The sign up link will be also in that follow-up email that we're going to send you in a bit. So thank you so much for joining our January Financial Fitness webinar. I hope everyone has a wonderful night. Take care. Thanks.